Test, test. Good morning, good morning. What's going on, guys? So Jerome Powell is going to be speaking today, and we're going to be live streaming that event. So this live stream starts in about 3 minutes for Jerome Powell, and it should be fun to see how it influences the overall market. So let me go ahead and pull this up, and we'll be showcasing it in just a couple of minutes. All right. Alrighty. Can you guys see it okay? Alright. What's going on, guys? Hope that you guys are all doing well. See how this moves the market. Okay, should be starting any second now. It should have started already. Looks like they're running a little late. Of course, thank you guys for tuning in as well. There it goes.
Inflation is back, and for the first time since before the 2008 financial crisis, the European Central Bank, the Federal Reserve, and the Bank of England, along with a host of other central banks, are all tightening monetary policy. But the threats to growth are immense too. Policymakers face a delicate balancing act between stamping out inflation and avoiding a recession. Ladies and gentlemen, for traversing this narrow path, Francine Lacroix, editor-at-large at Bloomberg, will be moderating the session. Francine, the floor is yours.
Claire, thank you so much. Now, we're here at the ECB Forum on Central Banking, and every year it's very clear that Sintra really dominates the attention of investors, but not every year is like this one. Now, for one, it's not, I'm told, quite as windy as it was yesterday, but that, of course, is not what makes this year so special and so unique. We're entering a new chapter for monetary policy, a divergence for almost 15 years of policy experimentation in an age really defined by stubbornly low inflation. Now, this year that has changed, as Claire was saying. Our policy panel needs a little introduction, but I'm going to do it anyway. Jerome Powell is the chair of the U.S. Federal Reserve, Andrew Bailey, governor of the Bank of England, Agustin Carstens governed the Bank of Mexico before becoming general manager of the Bank for International Settlements, and of course our host, the president of the ECB, Christine Lagarde. Now, just a reminder, between them, these institutions hold nearly $20 trillion worth of assets on their balance sheet, and they've, of course, maintained ultra-low, even negative interest rates for the better part of a decade with little disruption. They now have the unenviable position of presiding over the great unwinding of policy that may have permanently changed the architecture of global markets. So thank you all for joining us. We're going to have, I'm sure, a robust discussion over the next 90 minutes. Mr. Carstens, let me start with you as a central bank of central banks. You know, central banks in general have faced really a succession of crises over the past years, but also some of the structural factors, such as the green transition, digitalization, and increased onshoring. So how different will the future of inflation be from now on? How different will it be from the last decade?
Well, I mean, a very important change that has taken place in the last, I would say, 2 decades, or even more. If, for example, we compare this period of inflation with the 70s, is that we have much stronger institutional monetary frameworks and institutional framework for central banks, and I think they're far better positioned to combat inflation. If we go back 70s, and 70s have become a natural reference, we were at the time where, for example, the Bretton Woods was failing. You don't have more, I would say, instability in a system when you are, for example, revising your exchange rate regimes. And that is not happening today. I think that the period of disinflation there established very strong basis to create new and more nimble, more agile, better prepared central banks. And I think, for example, the design of the ECB, our host here today, in a way incorporated many of those learnings. So, I mean, when you are in charge of combating inflation, what you need to be able to anticipate is that sometimes you will be surprised, because there are many elements that affect inflation and that they are not directly under your control. And I think to a large extent this is what we are seeing today. And I see a very, very strong ability of all central banks to analyze, to incorporate that information and to react. For me, if you look very careful what is going on right now, in the last 2 years, we have seen dramatic changes in the environment. We went from having a situation where depression was felt, was feared, the deflation was coming, to a very quick rebound with the vaccination and so on and so forth. And we moved tremendously quickly from an environment of fearing deflation to fearing inflation. And that has been compounded by the Russian crisis. I have to say, monetary policy, as nimble as it can be, cannot respond with that celerity. So I think that the knowledge of the new form of inflation is being learned and is being responded. So I'm very positive that this institutional framework and strength of central banks today will take us to the goal where we want to be relatively soon.
Chair Powell, do you agree? I mean, when you look at complexity and uncertainty,
JP.
has it always been this way, but we forget about it? Or is this really a new frontier?
I agree with everything Augustine said about institutional progress. But I would add this. We've lived through a period of disinflationary forces around the world. This is globalization, aging demographics, low productivity, technology enabling all of that. And that was, so we've been in that world where inflation was really not a problem in most of the advanced economies most of the time. Since the pandemic, we've been living in a world where the economy is being driven by very different forces, and we know that. What we don't know is whether we'll be going back to something that looks more like, or a little bit like, what we had before. We suspect that it'll be kind of a blend, but in the meantime, we've had a series of supply shocks. We've had very high inflation now across the world, certainly through all the advanced economies, and we're, to Augustine's point, we're learning to deal with it. Our job is to find price stability and maximum employment, in the case of the Fed, in this new economy with these new forces. And it is a very different exercise than the one that we've had for the last 25 years. Nonetheless, the goals are the same.
So I don't know whether, Madame Lagarde, after this volatility, do we go back to something that resembles the last 10 years, or is it, something else completely?
I also agree with most of the points that Augustine made, and we don't have to agree between us because we always do. But I don't think that we're going to go back to that environment of low inflation. And I think that there are forces that have been unleashed as a result of the pandemic, as a result of this massive geopolitical shock that we're facing now, that are going to change the picture and the landscape within which we operate. If I look at our euro area, for instance, we have record low unemployment. We have inflation expectations, however imprecise and with the pinch of salt that was discussed at the last panel, which was excellent, we have inflation expectations that are much, much higher than they were. That's for the internal matters. But if you look at the rest of the world, a lot of the movements that we've experienced in the last 20 years was predicated on globalization, on the breaking down of supply chains, on the reduction of cost, on the just on time. That has changed and will probably change continuously
What the market's going up right now?
towards a system that we are not certain about at this point in time, which is much debated.
What's going on?
Some would argue that globalization will continue in a different format. Some would argue that the place where you manufacture, the place from which you provide services is good going to be determined by different factors than just cost. It will be about cost as usual, but
What the heck?
it's also going to be about where do I locate my services, where do I employ people, where do I reduce my costs, and are those areas, geographical as well as that the place where you manufacture, the place from which you provide services is going to be determined by different factors than just cost. It will be about cost as usual, but it's also going to be about where do I locate my services, where do I employ people, where do I reduce my costs, and are those areas, geographical as well as political, actually foes or friends? And do I have some predictability about the future of my production or the providing of my services? And the third factor that is going to change the scene from my vantage point is the way in which we produce. And I think that the shift that we're observing in Europe, certainly, towards green transition is also going to change dramatically the way in which we operate. And all those forces are going to produce inflation, deflationary impact that are still to be measured, but in the short run, I have some ideas as to where it's heading.
And we'll get back to those ideas shortly. Governor Vela, do you see this as a sea change for the longer term future?
Yes, I do. I mean, I think first of all we have to say that unquestionably, of course, our task is to return to low inflation. But I think, and we see this, every day, that in fulfilling that,
I swear it's not my internet. Everything's green on my side.
What can turn out to be structural change, and some of it I think, I would say is already getting there. So I think COVID is leaving a structural legacy on labour markets and the way they behave, which we're already beginning to see. I think sadly the European security situation has changed.
You'd be buffering to us if it were okay. I just want to make sure that you guys know it's not me.
As Christine was saying, that's affecting supply chains. It's affecting the resilience of the whole supply system. And you mentioned climate change, Francine. I would say that this is not, because some people sometimes say this is not some sort of dilettante activity by central banks. The reason that we're not in the lead on it clearly, but the reason we have to take it seriously is because it is affecting our world, and actually it will get worse. That's the sad fact of life, and we have to, in a sense, understand that, and understand. The reason that we're not in the lead on it clearly, but the reason we have to take it seriously is because it is affecting our world, and actually it will get worse. That's the sad fact of life. And we have to, in a sense, understand that and understand what effects it will have and how we respond to it. So these structural changes, are very important in our landscape.
So, Chair Powell, as these complexities or as these sands are shifting, is slower growth, much slower growth, an inevitable trade-off on trying to deal with inflation?
So I would say that if what we see, for example, is a redivision of the world into competing geopolitical and economic camps and a reversal of globalization, that certainly sounds like lower productivity and lower growth. And in many parts of this side of that, you see aging demographics, so a shrinking workforce, and you see economies that are growing more slowly and whose workforces are not expanding. So that's certainly a possible outcome, and I think probably to some extent a likely outcome.
And in the shorter term, can the economy, can the U.S. economy actually deal with, a possible onslaught of interest rate hikes?
So the U.S. economy is actually in pretty strong shape. So if you look back a year, the U.S. economy grew more than 5.5%. It was really the big reopening year. And so we had expected this year to be that growth would moderate to a more sustainable path. We also, of course, are raising interest rates, and the aim of that is to slow growth down so that supply will have a chance to catch up. We hope that growth can still remain positive. But if you look at the strength of the economy, households are in very strong financial shape. They've still got a lot of excess savings from forced saving from not being able to travel and things like that, and also from fiscal transfers. So households are overall, not every household, and not the ones at the lower end of the income spectrum, but overall in strong state. The same thing is true of businesses. Very, very low rates of default and things like that. Lots of cash on the balance sheet. The labor market is tremendously strong. Still averaging very, very high job growth per month. So overall, the U.S. economy is well positioned to withstand tighter monetary policy, we think.
But is it automatically a trade-off between fighting inflation or taking care of the economy, and how far are you willing to go with interest rate hikes?
So I guess I'd say it this way: our aim is to have growth moderate. It's sort of a necessary adjustment that needs to happen, so that again supply can catch up. It could be supply of workers. It could be time for the supply chains to improve. So the sense of that is that if we can get right now, supply and demand are really out of balance in many parts of the U.S. economy. The labor market being a big example of that. We need to get them better in balance so that inflation can come down, and that's the aim of what we're doing. Now, we don't have precision tools. Obviously, monetary policy, famously a blunt tool. That is our aim. That is our intention. We think that there are pathways for us to achieve that, to achieve the path back to 2% inflation. While still sustaining a strong labor market. We believe we can do that. That is our aim. There's no guarantee that we can do that. It's obviously something that's going to be quite challenging, and I would also say that the events of the last few months have made it significantly more challenging. Thinking there particularly of the war in Ukraine, which has added tremendously to inflationary pressures around food and energy commodities and agricultural chemicals and industrial chemicals and things like that. So it's gotten harder. The pathways have gotten narrower. Nonetheless, that is our aim, and we believe that there are pathways to achieve that.
President Lagarde, can you talk to us about this fine balancing act for Europe and what that means?
What I find extraordinary is that sort of 10-15 minutes into this debate, we haven't really used the word energy. And certainly in this part of the world, the energy shock that we have suffered, are suffering, and probably will continue to suffer, has had a major impact. And I think this is not specific to Europe, but there is certainly a dependency of European countries, and the euro area is certainly a point in case, to external supply from foes. And that has had a major impact on prices. It is certainly a very driving force, a strong driving force of the inflation that we have experienced in the last few months. This has been, as you said, Jay, exacerbated by the war. And I think the proximity of Europe relative to the war scene has had probably a more significant impact on the price both of energy and of food, which are clearly very important components to take into account, including in inflation expectations, as was discussed earlier. But we also have, that then is a series of supply shocks that are hitting the European economy. But we also have this recovery that is very much underway, that is certainly driven by services because of the swing that we've observed from goods to services, and which is also supporting the economy. We have very low unemployment numbers, high employment participation. Some of it is more attributable to public service jobs than private sector, although that is also back to pre-pandemic moments. And we have a couple of other items, such as significant savings that are still to be used, hopefully, or not. And we have fiscal policy. And the fiscal policy that we are seeing at the moment is roughly in the range of 1% GDP. But we need to see how fiscal authorities move, where they move, and we certainly hope that they will move in a targeted, temporary way in order to make sure that they support the most vulnerable and not in a broad and discriminated fashion as we have unfortunately observed so far.
And why do you prefer actually the more gradual approach? So yesterday you reiterated 25 basis points
gradual
hike.
For monetary policy?
For monetary policy.
Well, don't forget, I didn't say gradual full stop. I said gradual but optional. Yeah. And I think it's a combination of the two that actually matters for us. Moving gradually is certainly appropriate in times of very high uncertainty, but as the uncertainty will clear on various accounts, we will have to certainly be less gradual and give more way to optionality. But we have both of them in combination at the moment. Optionalities being also a very critical aspect of our determination.
Mr. Carson, I mean, you've been pretty vocal actually on what central banks should do. Do you think they need to cut faster?
Well, I mean, I think everyone should react according to their own circumstances. What is very satisfactory at this stage is that pretty much all central banks have starting address the issues. I mean, one way of dealing with this is through words, to recognizing you have a problem, to saying that you will address it, and pretty much all have already entered into the field of action. So central banks have been acting in consequence. I have to say the level of interest rates worldwide have adjusted. The level of interest rates, if you look them from the yield curves, they have been increasing quite substantially. What we can say is that global financial conditions have tightened substantially, because we don't have to, we shouldn't forget that this in a way has become a global phenomenon. I mean, inflation around the world has been increasing. Now, each country, as Christine and Andrew J has been saying, each one face different dynamics of inflation.
I see some of you guys are having issues. If you guys see some form of delay, I mean, you guys can just refresh your screen and it will pop the live stream right back up, and it should be as close to live as possible. So I appreciate it, and I hope that I earn your thumbs up. Thank you.
A full transition from a low inflation environment to a high inflation environment where this high inflation gets entrenched. And for that, basically, you need to prevent these vicious cycles to kick in. And pretty much all of them are addressing it. In these vicious cycles, labor markets are very important, and labor markets are very different across the world. Therefore, I think that there is no one recipe or no one remedy for all. But what I'm seeing is that pretty much all central banks have been addressing the issue in a forceful, determined way according to their own circumstances.
Mr. Carson, does it mean that you would be in favor of, front-loading hikes so that it's a powerful message, maybe to people, for a lot of the citizens?
Well, let me give you a good example, and to introduce a little bit of a different flavor here. I come from emerging markets, and if you see how emerging markets have been acting this time around compared to other periods of very high interest rate increases in advanced economies, or the expectations of fast increases in interest rates, they have acted quite well, I mean, if you see, the more recent episode was the temper tantrum, where many emerging markets suffered dramatically with the expectation of higher interest rates. My own country, Mexico, several of our crises have been associated with rapid increases in US interest rates, but we have learned our lesson. And so what you see is emerging markets traditionally were the ones who would increase interest rates at the very end. Now they started very early on. And what you can see is that they have managed to keep their exchange rates quite stable. Traditionally, in emerging markets, exchange rates was a very important source of inflation. So now they're still facing the sources of inflation from the commodity shocks, from energy, from world aggregate demand, but not the ones that could have been inflicted by the movement in the exchange rate. So there you see that different central banks can act at a different pace. For them, it really was critical to act forcefully and very, 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 very early on in the game. But that's not the circumstances you see around. So I mean, I would say that each central bank is playing its own game because it's different circumstances.
There's about 3 more minutes until the market opens. Just a heads up for you guys.
We opened the door for 50 basis points.
Well, I think the way I would frame that, it very much goes back to what the others have been saying. And as Christine was saying, I mean, we are being hit by a very large national real income shock, which is coming from outside. There is uncertainty around two parts of that in terms of monetary policy. One is, of course, the eventual scale of it, because it's unfortunately still evolving. Secondly, the impact of it, precisely how it passes through into the economy and what the effects of it are. But the scale of the shock is very substantial, and in and of itself it will have an effect, a big effect, because it will reduce domestic demand and it will pass through into the labour market and it will pass through into inflation. Monetary policy has, of course, a very important role to play because it will act alongside that shock. And it's very important, as we've said, and this is where we come to the language that we use, that it, of course, it is there also to tackle the second round effects as they come through price setting and wage setting. So the message that we gave and was in the language of our last meeting, as you rightly said, was that if we see greater persistence of inflation, that's second round effects, then we will act more forcefully. And we will have to act more forcefully. Now, in terms of your precise question, what does that mean? Well, of course, I'm not going to say what it means at our next meeting, because our next meeting is still a month away. A lot will happen between then. What I would say to you is that, of course, it leaves options on the table, and that's very deliberate. Very deliberate. I mean, I want people to take a message away from that. It's quite clear that as we respond to this shock, we want to have those options on the table for precisely the reason that Agustin has just said. There will be circumstances in which we will have to do more. We're not there yet in terms of the next meeting. We're still a month away, but that's on the table. But you shouldn't assume it's the only thing on the table. That's the key point.
But Governor, for you personally, would you be leaning towards 50 basis points?
No, because I'm going to see what happens in the next month. I'm afraid one thing that is omnipresent in our system is that we make policy meeting by meeting, and there's always another meeting. If you can only guarantee one thing in monetary policy, it is that there's another meeting.
Yeah. Is it actually annoying that markets or reporters always try and understand, some of this very personal thinking on interpretation, for example? Chair J. Powell, I tried my luck with Governor Bailey, but how do we, how should we be thinking about this? Like, is it, markets or reporters trying to really always get just that nugget piece of news?
Yeah, well, certainly there's a lot of that going on, I would say. But no, I guess I would, to put a more constructive spin on it, the markets and market participants are always wondering what we're going to do. They're always wondering what we're thinking, and when market moves happen, that's really a constructive thing. It's never going to be exactly what we're thinking, but nonetheless, it's constructive that the market in effect is doing your work for you if it correctly understands your
All right,
action.
market just opened.
That's maybe a more constructive way.
And is it correctly understanding what you're saying right now?
So I would say, by and large, I think over since last fall when we pivoted to raise rates and get where we are now, since then markets have been pretty well aligned. I wouldn't bless any particular day, for example, but pretty well aligned with where we're going. And right now, the market pricing is pretty close to where the summary of economic projections from 2 weeks ago was. So my colleagues and I wrote down numbers for the end of this year for our policy rate between 3 and 3.5%, and markets are broadly right in that space somewhere. And then for next year, between 3.5 and 4%. So broadly speaking, I think it's working. And we're all, everything we say in terms of forward guidance, to your point, is always going to be conditional on the things that happen between now when you give the guidance and when the actual event happens. And sometimes markets can forget about the conditionality part.
But is there a problem actually with forward guidance in this kind of environment because it gets priced in straight away? So it feels sometimes like markets lead and central banks follow because of the forward guidance.
It doesn't really feel that way at all from where I'm sitting. It feels quite the opposite. And no, as I said, I think people will look back on this period and say that we were able to have financial conditions tighten quite substantially, and we've only had 3 meetings at which we raised rates. Nonetheless, the forward rate curve is pricing in a rate path that looks a whole lot like the summary of economic projections that my colleagues and I submitted in June. So that's a good thing. That's the market understanding and finding credible what we're writing down. And of course, it's all highly conditional, but nonetheless, I'd say that's a positive thing.
Yeah. Do you agree, Madame Lagarde? Is it a positive?
There it goes.
I would agree. From our vantage point, we are on a normalization path. We have signaled that very clearly. We've started that back in December, and the key assessment is the assessment of the medium-term outlook. The variables that we look at, the data that we look at, I think everyone is aware of that. And Most people operate on the basis of the same data, the same information, and I think that our reaction function is what matters. And as long as that is understood, the fact that we are on this normalization path, that we are gradual but optional, that we're going to be data dependent, we've indicated very clearly what's likely to happen in July. Yes. What's likely to happen in September? Yes. And, you know, in the path that we are on, I think that markets have full understanding and appreciation of what we are doing, how we're doing it, and then the level of uncertainty as it clears will probably help us towards this optionality that I was describing earlier on.
Governor Bale, do you agree actually with the market function so far? Have they broadly understood what the central bank's trying to do?
Yes, I think they have. I think the tricky thing that you see, certainly I would say we see, is that we can obviously see direct market pricing.
Market's still dropping.
Market curve which prices in what we're going to do. We also, as you probably know, and we just started doing this recently, publish a market survey at the same time as the meetings, and that actually shows a lower path of rates. So we spend quite a bit of time understanding the difference between those two. I don't think it's actually hard to explain, because I think the underlying reason is that the market curve prices in the risk, and the risk is on the upside, and I would agree with that. So whereas the survey is a straightforward point to point number, the curve has got the risk in it. So I think for me the best way to look at that difference is the risk, but that is a risk in that sense. It's important to see that that perspective.
Yes, absolutely.
Not to get ahead of ourselves or to have to become big-headed about it, but there's a point that was made in the previous panel, which we all agreed over lunch, which is that it's not a science what we're doing. There's an element of art, I don't know whether you characterize it as art or not, but it is not just driven by sciences, and we know that models have had their shortfalls, particularly turning points. So there is also that element that is sort of privy to the deliberations that we have in our various governing councils and FOMCs and what have you.
Yeah. Yes.
Can I just add, we're talking a lot about markets and how we react to markets. Actually, to Christine's point, the way we're thinking about it is what policy setting do we need to put down to achieve the real economy goals that we're working on. And that's what we're not thinking, wow, let's try to match up with the markets. We're thinking, what's the right policy based on our the incoming data and that again, that's what we're thinking about.
Yeah, and I want to go back to the real economy and inflation in a second. But Mr. Carson, what do you make of some of the what we've seen in market volatility? Is it just a readjustment? Is it a misunderstanding? Is there something that could turn uglier?
Well, markets are responding also to the circumstances. I think as policymakers to some extent have been surprised, because there has been news that really are news and that were very difficult to anticipate. Markets are doing the same. And we have to, and you know this very well, markets are turning around very big positions. They're adjusting their portfolios. We are talking about a circumstance where for very, very long period of time, we had tailwinds in the bond markets. That we had very low and falling real rates of interest, falling nominal interest rates. So trading bonds was relatively simple. We had very big expectations for earnings into the future, a lot of interest in different sectors of the economy.
Quick little heads up, TQQQ showing signs of a potential support. It just hit lows of 24.16 for those that care to pay attention to it. Just a little update for you.
And central banks need to do their work, not as an objective in itself, but as all these central bankers have been saying, to fix a problem, which is inflation, and then continue with a much better world moving forward. So there are certain circumstances in markets where frictions are bigger. Trading conditions are not always the same. I mean, you get circumstances of crowded trades because at some point The same type of investors are trying to do the same operation, and liquidity is not necessarily there. Something that for me has been very positive is that central banks, the leading central banks, have been able to implement their money policy adjustments without really generating such big, any sort of market disruptions. Markets have been performing well, liquidity is there, market making is going forward. Yes, there has been some disruptions. I'm not talking about the cyber world, that's another fish, or how do you say it, another kettle of fish. But you know, I think that the markets have been working really well, and yes, behind the actions, easy, and so far I would say so good.
Yeah. But at what point, and I think that maybe the last point on markets is how much do central banks need to deal with markets, Mr. Carstens, to see, to I guess impact the real economy?
That's for you.
How much do we deal with them? I'm sorry.
Yeah, I mean, how much do you need to focus on markets to make sure that also the real economy is quite strong?
Well, I mean, we spend a lot of time analysing markets, and all of that is fed into what impact those changes have on the inflation outlook. I mean, that's why we do it. With the second objective, as Agustin rightly says, of course, about market stability, because after all, we've also got financial stability obligations and responsibilities. I mean, I think I'll go back to the panel this morning very briefly. I think the point was rightly made that it's turning points that are the hardest. Often to read, and it's not just for us, it's for markets as well. And I think certainly when I look at the UK economy at the moment, it's very clear that the economy is now starting to slow. We are at something of a turning point in that respect, and I think the fact that markets are having to take that on board, and that the data can be quite choppy at that sort of point in time, is reflected in some of the short-run movements in markets. Now, I do think one of the essential things for central banks is to look through that short run. Yeah. We have to extract the information and then look through it, because obviously our objectives are much further forward in that sense, in terms of low inflation and returning to target. But in terms of taking the information out of markets, yeah, it's a very important activity for us.
Chair Powell, Paul Krugman, I think on Friday, said that the number one risk to the US economy is that the Fed could overdo it because inflation could come down as quickly as it went up. Is that really possible?
Well, we'd certainly welcome inflation coming down more quickly than expected, and we would take that into account in our policy. So as I mentioned earlier, we're very strongly committed to using our tools to get inflation to come down. The way to do that is to slow down growth, ideally keep it positive, and as I mentioned, supply and demand get back into balance. So that's what we're trying to accomplish. Is there a risk that we would go too far? Certainly there's a risk. But I wouldn't agree that it's the biggest risk to the economy. I think the bigger mistake to make, let's put it that way, would be to fail to restore price stability. And it's what Agustin was speaking to earlier. A low inflation environment or regime is what we've had, and that is one in which inflation is low and no one pays any attention to inflation, and that's called rational inattention, because it doesn't matter. When there's a big inflation spike, if it's going to go away, we would ignore it and sort of play through it, because it'll go away and it won't affect people's understanding. But to the extent there are a series of shocks, it does become rational for people to pay more and more attention. And I think the clock is kind of running on, how long will you remain in a low inflation regime where most of the changes in inflation are actually idiosyncratic as opposed to broadly across the macroeconomy. So the risk is that because of a multiplicity of shocks, you start to transition into a higher inflation regime. And our job is literally to prevent that from happening, and we will prevent that from happening. We will not allow a transition from a low inflation environment into a high inflation environment.
Is there a point where actually inflation expectations get de-anchored? And is that
That's another way of saying it or thinking about it. It's the same thing, same idea. And the thing is, you never really know. There's no way to know in real time. We all study inflation expectations very carefully, and if you look across the broad scope of short, medium, and long-term expectation, you'd still say that we have credibility, that they're well anchored. But there's a clock running here where we have high inflation running now for more than a year, and no one should assume, it would be bad risk management to just assume that those longer term inflation expectations will remain anchored indefinitely in the face of persistent high inflation. So we're not doing that. As a risk management matter, we're working very hard on the part that we can affect, which is the demand side. We can't affect the supply side, really. But we can affect the large parts of the U.S. economy where there's surplus demand, and that's really our focus.
Is there a data point that you watch for to actually see whether there is a de-anchoring, or where do you see it first, basically, if it spirals?
The point is not to see it at all. We can't. Once we start seeing that, the cost of dealing with higher inflation goes up so much to the extent you find yourself in a higher inflation regime that you just can't allow it to happen. So if you're starting to see serious de-anchoring of, and we're not, of longer term inflation expectations, then you're behind. And I think right now we're doing what we need to do, which is to move expeditiously and into restrictive territory fairly quickly. I think that's what we need to be doing so that we don't find ourselves in that situation.
President Lagarde, what's the situation like in Europe? We had a pretty ugly CPI number from Spain this morning.
Yeah, numbers from Germany that are below what economists expected. So I think it's a question of waiting until the 1st of July when we have the consolidated number for the whole of the euro area, and we'll see, because we are data dependent. But just like Jay, our mission, our mandate, our job is to provide price stability, which we have defined as 2%. So we currently have inflation at forecast 6.8 for this year, moving that down to 3.5 and 2.1 in 24. All of that is above target throughout the whole projection period, and we need to do what we have to do, which is to bring it back to 2%, and we shall do so. Now, of course, we are not exactly in the same situation as Augustin was saying. We need to look at our markets, we need to look at forces, we need to look at how the uncertainty that we have on the horizon is going to clear. And I think that in that respect, what happens on the energy front, what happens on the war front, unfortunately, what happens in relation to wage negotiations, and how inflation expectation continue to stay anchored as they have re-anchored, are some of the elements that we will be looking at very carefully in the job that we have to do to bring inflation back to 2% over the medium term. That's the same determination.
Yeah, Governor Bailey?
Well, I agree. I mean, like Christine, I am concerned about how the war front and the energy supply front is going to evolve. I think that is the major risk. I think, by the way, if I say, we had an inflation number out last week, and what I thought is that on the surface it was pretty much in line with what we expected. Underneath the surface there was a sign that we saw a shift in the makeup of inflation from the goods supply shock to the energy and food shock, which I would sort of characterise as the post-COVID supply chain shock, moving more sadly into the Russia-Ukraine world. And obviously we watch that very, very, very carefully as we go through the year. As we've said in our last monthly policy report, unfortunately there is going to be a further step up in UK inflation later this year, because that's a product of the way the energy price cap in domestic energy prices are set based on the data that we've observed over the last few months, and we have to take that into account. But as Christine and Jay have said, the key for us is to bring inflation back down to target, and that's what we will do.
Hindsight is a beautiful thing, I know, and I also know the ECB published a paper and saying, what you got wrong on inflation. But going forward, Mr. Carstens, how do we need to look at inflation differently? So, for example, in the US, and I'll ask the same to Chair Powell, the stimulus, did we miscalculate the impact this would have on inflation?
Can I just say one thing? I think it's a very healthy exercise to actually assess why you were off the mark. And if all of you actually do the same exercise, you will probably realize, for most of you, that actually energy was vastly underestimated, and that bottlenecks were also expected to clear much faster than everybody had expected. And I don't think the ECB is alone on that count. No. We're the first one to have a...
That's a good question. So they just asked, when is the next, let me go ahead and find it. So when is the next big economic data report? So the CPI reports, for those that are unaware, are released around the 10th and the 11th of every single month. So just make sure that you're aware of that, especially for this up and coming month, for the month of July, to see if we actually saw peaked inflation. If we see that inflation has peaked, that should act as a positive catalyst. And for those that are unaware, I put the VIX over here. Anytime that the VIX rises, that means that fear is rising. When fear rises, markets drop. So as you can see, again, it's good to understand that correlation.
That to some extent kept, I would say, for some time, giving the indication that inflation could not rise that fast. We faced many limitations like that. I mean, I have to be very transparent. Last year, we tried to crank out some numbers of inflation, and we put them out there. And here's one of the researchers that did the job, and he had a hard time cranking up higher numbers as much as he tried. And we had it at the end of the day wrong. And part of it, I mean, I'm not blaming it to him, no? It was my responsibility too. But that was the toolbox we had, no? Now we find that, there are many different hidden relationships or very key aspects about inflation expectations, expectation formations, situation in labor markets that can give you non-linearities, Therefore, we had a very nice model for normal circumstances, but as it has been said periodically here or in a reiterative fashion, turning points is what is very, very difficult. So we have entered into dynamics that are very different. So I think where there needs to be a lot of work is, and we started doing some of that job recently in the VIS, is to understand much better what is happening with inflation under the hood. Why some relative prices eventually become more contagious, to use that word, and start spreading around. Why some shocks are more perdurable than others. Why there are some prices that generate more spillovers. What determines the frequency of firms revision of their prices, which certainly increases with inflation. The new technology that we have talked about, I mean, now we have Amazons and we have all the these markets that probably were not there, certainly were not there when CPIs were calculated a few years ago. So there is a lot of things that we need to catch up. So I think it's a challenge for us. I think as we are accumulating all this information, I'm sure also will give us, and is giving already, more leading indicators of what inflation is doing, and that will be very, very helpful to calibrate a response. So yes, I mean, I think inflation will evolve. The inflationary pressures we're facing today are very different than the ones we had in the 70s, and I'm sure that the bout of inflation we might see in some decades forward will be also very, very different. So we need to preserve that nimbleness analytically to approach, and also be very mindful that we need the right instruments. And another thing that has been very useful is that the different banks the central banks have been able to adapt their instruments to do monetary policy according to the circumstances.
But does everybody on the panel think they understand inflation better now than they did 4 or 5 months ago? Because you could also have, again, going back to Kruger's point.
That has been very useful is that the different banks the central banks have been able to adapt their instruments to do monetary policy according to the circumstances.
But does everybody on the panel think they understand inflation better now than they did 4 or 5 months ago? Because you could also have, again, going back to Krugman's point.
Can I say something?
Yeah.
I mean, certainly I believe that we understand it a little bit better, not fully. There is a sort of a big, I won't say black box, but certainly gray box, where I think in the profession of economists we need to do better. And that's understanding aggregate supply. We are, at least I myself consider myself an economist that I was trained under the dominance of aggregate demand. And we know a lot how to get the demand responds to interest rates, how they respond to income, how monetary policy and fiscal policy has a transmission mechanism to aggregate demand. But we usually take aggregate supply as given. And it's very complex, it's very, very complex. And I think we need to understand far better aggregate supply. One confusion that is out there today, I think, is that the flexibility or the inelasticity of supply in the short term is there, but that doesn't necessarily makes it the same as a bottleneck. What is the difference? How impact that on inflation? So I think the understanding of aggregate supply that also includes labor markets is of the essence. So from the challenges we are taking forward, for me that is one that is very important.
I like the idea of a grey box.
In addition to aggregate sectorial supply, as we learned this morning with great interest, is also worth it.
Jerome made a point earlier, and it's very important that we've had a series of supply shocks. This is the thing. I mean, the word transient has become discredited, but it isn't really in one sense, because that was built on a single supply shock idea. That supply shock can work its way through. The duration of that supply shock can often be shorter than the response of transmission response of monetary policy. Now, we've not been in that world. We've been in a world where we've had a series of supply shocks. I mean, I look at our shocks. Yes, we had an initial demand shock from COVID, but then we had a supply shock with the supply chain recovery problems. We've had obviously a very serious supply shock coming from energy and the war, and we've had a labour market shock in the UK because labour force has reduced in size. And it's, as Jay was saying, it's how you deal with a series of supply shocks, large supply shocks, with no air gap between them, which of course feeds through into expectations, because put them all together, they're not transitory in the traditional sense of the term.
Sure, Powell?
One way to say it would be, I think we now understand better how little we understand about
That's
inflation.
not very reassuring.
No, honestly, this was unpredicted. I was looking at our at the time of our June meeting 1 year ago, of the 35 people who filed with a survey of professional forecasters, 34 of them had inflation below 4% for last year. And of course, it was way above 4%. So really everyone had the same model, which was the Phillips curve model, and it just was not capable of producing high inflation. But what it was missing was something that's completely missing in the data for 40 years, which is basically a collapse of the supply side. The U.S. economy is famously adaptable. It has the minimum of structural rigidities, all that kind of thing, and yet here they are. So what you had was very strong demand, but hitting effectively a vertical supply curve. So ordinarily, when people want to buy cars, which they really did because they didn't want to ride on public transportation, rates were low, they had all these savings, the car companies would make more cars, and they might raise prices too. In this case, they couldn't make as many cars. So what you got was straight up the vertical supply curve, a big price increase. But I also think, in principle at least, that process could work in reverse, so that as demand comes down, inflation could actually come down more quickly there are other relationships that people think about when they think about how do you get inflation down, which are more typical of a simply overheated economy and entrenched inflation, the sacrifice ratio and those kinds of things. But I think this could be, I don't know that it will be, but it could be different because it's just that process working in reverse potentially.
Do you see that process, President Lagarde, working in reverse? So actually, I know it's different because
what we're seeing at the moment is more this swing or substitution that was described earlier in the day, where because of COVID, everybody suddenly decided to stop using any kind of services, particularly if there was social distancing about it, and move to goods, hence the car industry in the US and stationary bicycle rather than the fitness club. And now we are seeing this sort of substitution back to services where people who've been deprived of restaurants, hotels, transportation, theatres and all the rest of it, that side of it is currently booming and is sustaining the recovery that is otherwise under the various series of shock that Andrew was alluding to. So
quick little heads up, you guys can see my charts on the left hand side. TQQQ is showing signs of an uptrend. I'm adding a little bit more to my position size. I know I have a couple of our Learn Plan Profit traders in the chat, so just making you guys aware of what I'm deciding to do. Also a heads up, we are experiencing that resistance at around $25 a share, so direction is not super clear. If you wanted to wait a little bit more for clear direction, 100% being conservative during uncertain times would be useful. So just an update for you guys.
For the moment, more in the scenario planning world than in the remodeling of what's going to happen on gas prices.
Mr. Carson, talking about emerging markets a little bit. So first, it's I don't know whether they're coming to their stride because they're used to the volatility, but there are huge implications, of course, of what the dollar is doing.
Yes, of course. I think at the end of the day, a very strong dollar implies for many of them very tight global financial conditions. And so far, again, as I mentioned, the exchange.
That's actually a really good question. We have someone asking, I do not understand why the market is rising. So TQQQ is up barely anything. The overall NASDAQ market's pretty much barely in the green. One of the things that you must understand is that markets rise when things begin to not get worse, right? As soon as we hear any form of news or any speculation about anything, the markets drop instantly. The stock market is unlike many other markets where it takes time, such as real estate, to get factored in, right? It's not until a couple months later that we see that delayed reaction. The stock market is different. If things are not getting worse, then they're getting better. And that's what we tend to experience. COVID is a perfect example of this, where things were not necessarily getting better, but they just weren't getting worse. And then that's when we began to see markets recover. So please make sure that you understand, sometimes it doesn't make sense to people, but it's because things get factored in instantly that markets tend to recover. So just wanted to explain that to the best I could.
In their basket done in advanced economies, so that obviously reflects itself in more social need, and where of course many governments, according to their capacities, they are doing programs to assist people. So at the end of the day, they are on a tight situation. They have to manage things very prudently. I think if we compare this with other periods, emerging markets are better prepared. But I think that the challenges are there. I think a big challenge for many emerging markets, including I would say China, is how to get growth back at a much healthier pace. I think the growth in emerging markets has slowed down, not now, but even before the pandemic. To some extent, the virtues of globalization have sort of run out of steam, and therefore the relevance of structural reforms are very important. We need to look much better into how to get growth going independently of the use from fiscal and monetary policy, and to a large extent that also applies to advanced economies.
Thank you. Governor Bailey, do you think inflation in the UK will be more elevated for longer than in other parts of the world?
Well, as Christine has said, we are going to be affected by the shock that Christine described in terms of energy prices in Europe, because essentially it's a common shock in geographical Europe. I use that term carefully, because it's a single, particularly for gas, it's a single supply system. So although we don't actually import a large amount of gas from Russia, it doesn't, in a sense, the price is formed outside that particular. So in that sense, we're similar. I think where I would, as things stand, expect
Testing $25 a share for
TQQQ.
TQQQ.
Headline rate is because we do have, as I mentioned earlier, this price capping system in domestic energy prices. At the moment, it's a 6-month cap, but there is a proposal to take it down to 3 months. But other things equal, you would imagine that that will put a bit more persistence in. And we will, of course, have to explain that, because if we can observe a downward path of underlying inflation, we will have to be very careful to explain that if that's how it emerges.
But does Brexit actually make bringing down inflation harder?
Well, Brexit, I should say, it's very hard at the moment, if not impossible, to separate out the immediate effects of Brexit and the immediate effects of COVID. So when I look at trade and when I look at labour market particularly, you can see effects taking place, but you can see that COVID and Brexit are having similar effects. And the reason I say that is because the Bank of England for some time now has had a sort of a path of a Brexit effect.
Do you guys see this correlation? When the VIX begins to drop, TQQQ begins to rise. Again, we talked about this yesterday and why it's so important to at least understand it. You don't have to ever trade off of it. Again, I 100% agree that there's not one indicator that is 100% accurate. But when you ask me the question, how is it that I understand the correlation when markets tend to peak, I use the VIX, considered as the fear index, as a good reference, or if you want to call it indicator, to have a better understanding of when fear is high or when fear is low. Again, this can give me a better understanding of when I can really begin to step on the gas. So for those that began to ask, why did I start buying TQQQ? Is because I began to see the VIX trade sideways, showing signs of a resistance and no longer beginning to rise. When the VIX begins to drop, normally the markets begin to recover. So please understand that correlation. I just wanted to explain it to you.
Good and bad movements in the exchange rate. It's one of the many things that goes into the analysis process in terms of how we think about the evolution of inflation.
I was going to ask you about the dollar and whether that helps with price stability, dollar strength.
So, like Andrew, we don't have responsibility for the level of the dollar. That's the elected government's job. That's the Treasury Department's job. And so it's just another financial condition to us. And since our economy, the external sector in our economy is so much smaller than it is for the others here, it's not that important. But dollar has been strong, which would tend to be disinflationary, but only at the very margin.
I mean, I think what we're seeing these days are adjustments in exchange rates. But I think the way of thinking of those adjustments in most economies, including in emerging market economies, are part of the adjustment process. I mean, they are endogenous variables. For example, the dollar is stronger because the US economy is stronger, because interest rates are higher, and also how the shocks that are around are affecting the different economies. So the fact that you have a very strong commodity price in Europe with gas and so on and so forth is very logical to think that the real exchange rate will depreciate. And that's part of the adjustment, So I think we're in a world where in most of the cases exchange rates are part of the adjustment. In some cases, in particularly in emerging markets, it has more of an impact in the monetary policy management, is because the pass-through for moving of the exchange rate into prices is much higher than in advanced economies. So in advanced economies, it doesn't, unless there are huge swings, the impact on the trajectory of inflation is not that relevant.
Chair Powell, Mr. Carson was talking about a gray box. What's your gray box? Is there something that you wish you knew that would help in setting monetary policy? Only one thing.
Yeah, no, I'd go back to the same thing really, which is what did we get wrong? And that really was looking at these supply side issues and believing that they would be resolved relatively quickly. And that by that I mean there were going to be vaccinations, everyone would get vaccinated, so the millions of people who dropped out of the labor force would come right back in, so wages wouldn't be under such pressure. That didn't happen for a range of reasons. It didn't happen. In
VIX
addition, the
showing signs of a
bottlenecks and the
support.
shortages haven't been alleviated
TQQQ
yet. And
showing
then
signs
on
of
the back of that
resistance.
comes the new shock in the form of the war. But it wasn't something wrong with our models, because it wasn't in the models at all. It was a question of how to assess the persistence of these supply side shocks. And I do think that there'll be, to Augustine's point, and there is a lot of work going on to get smarter about the supply side. In the nature of it, though, it was a deep in the tail kind of a risk, and those are very hard to predict and assess it when they come.
Yeah. Because monetary policy is not an exact science, how often do you actually speak on the phone to exchange ideas? Do you call each other and say, like, well, I've done it this way?
I can help out. I mean, because part of my job is to be able to attract them to Basel 2 times every 2 months, to have very, very deep and open exchange of views.
We do talk, but we're not going to tell.
And you also.
We speak quite often.
Quite a lot, but you're not going to tell. President Lagarde, the ECB decided to apply flexibility to reinvestments from Friday, July the 1st. What will be the guideposts?
We decided. Look, I think if you allow, I'd like to just come back to why that is.
Yeah.
Because I think that
Here we go. The VIX is dropping once again, and TQQQ is rising. So we're retesting that same resistance at 25.30 a share. Just a reminder.
let's say 19 for the moment, member states that each have their respective fiscal policy, that each have their respective financial markets. And as a result of that, our unique monetary policy has to be transmitted throughout this imperfect market of ours, which has no fiscal union, no monetary union, no capital markets union. And as a result of that, we just have to make sure that our monetary policy stance is actually transmitted throughout the entire euro area. And the two of them, I think I used that word, I don't know if it exists in English, but they are consubstantial. For our stance to be effective, it has to be transmitted throughout. Okay? So to do that, if we see that there are unwarranted disruption to that transmission, and if our stance is impaired as a result, we need to take action. And that is the reason we decided that we would use, as of, you're right, Friday, that's what I said yesterday, we would use the flexibility in the reinvestment of our pandemic emergency purchase program redemptions in order to address the potential risk of fragmentation. Second, we also decided, and it's work in progress, so I'm not going to comment upon it. I know that some would like to have details and understand before everybody else, and particularly before the Governing Council, what the details of that instrument will be, but we decided to reinforce our capacity to properly transmit our monetary policy by devising a new tool that will be considered by the Governing Council of the ECB on July the 21st. So don't waste your time asking me for details, criteria, conditions, safeguards. All I said is that it has to be effective, it has to be proportional, it has to include the right level of safeguards. And that's all I will say at this point.
Okay. How do you direct
and
staff?
it will be effective, and it will be proportional, and it will have safeguards, and it will be there, believe me.
So how do you direct staff? I'm going to try my luck one more time. How do you direct staff when they design this new tool?
I said what I had to
The
say.
lady is
thank
not
you.
for turning, is the famous way. How do you look at China, Mr. Carstens? How should we look at China at the moment?
Well, I mean, it is of the essence that things start improving more quickly in China. I mean, certainly we need the growth that has come from China.
Mm-hmm.
They play a very important role in the supply chains. I mean, many of the tensions we're seeing around the world could be mitigated by having higher growth rates around the world. I mean, part of the way we have started.
All right, guys, I'm going to keep the live stream going. I'm just going to take a little bit of a break. But one of the things, I just wanted to recap it for everyone that's just tuning on in, especially if you're absolutely new to the market. So pretty much this meeting that we had today is some of like the world leaders for different parts of the country, right? We have Jerome Powell representing the Federal Reserve, which of course oversees the United States. And with that being said, I mean, nothing new has been said. Jerome Powell still talks about the tools only being able to use specific tools in effort to moderate inflation. They all agree that taking inflation head on was the best approach that they could have done. There's a lot of people in the live chat that agree or disagree with specific things that these individuals are saying. And it's because we can always look back and be like, I agree with most of you of like, we should have not printed as much money. Obviously that was going to be a consequence of we saw this little statistic where in the past 2 years, we have printed what is now 80% of the money circulating in the United States. And I think that's pretty insane, right? So yes, there is a lot of money printed. Obviously, looking back, there's a lot of different steps that could have been taken in effort to kind of just like have cushioned the type of inflation that we would have experienced. But like they said is, they can't predict the future, right? All they're trying to do is now learn from the mistake that they have made in effort and in trying to tackle on inflation head on. That is why they're taking a super aggressive approach when raising interest rates. It's an agree to disagree. All they're literally doing is trying to the best of their ability to moderate inflation. And they're doing this head on. It would be more concerning seeing how high inflation is and still not taking an aggressive approach in effort to alleviate kind of some of that weight. They also did say, there are certain factors such as oil and food, right, for logistic reasons, that is something out of their control. They can't do anything about supply. All they can do is try to use their tool, as in raising interest rates, to moderate demand. By raising interest rates, you make it more or less desirable to want to spend money. Therefore, it encourages people to save money. By spending less money, it allows supply to catch up with demand. So demand is the only thing that they can begin to slow down in effort for supply to catch up with it. I just wanted to make sure I do my job in keeping this very simple, at least as simple as I could possibly do it, for you to have a better understanding of what is being said. I understand that it's very, very confusing. I hope that it's something that maybe makes a little bit more sense as they continue to talk. I'm going to continue to host the live stream, but I'm just going to leave it here for a couple of minutes. I hope that I earned your thumbs up. I would love to host more of these live streams. I don't know if you guys are new to my YouTube channel. I upload new videos every single day about the stock market that's designed for complete beginners. So please, if it's not too much to ask, I hope that I earned your thumbs up. Please consider subscribing. And if you are absolutely new to the market and you simply want to connect with other like-minded traders, the first link, you guys can refresh this video. The first link in the description of this video is my free trading group chat. We have over 40,000 members worldwide. You don't have to join. It's just an option if you want to stay connected. I do trade live every day. So if you want to be able to see what it's like to watch me buy, watch me sell, watch me and share my thought process, I only work with my Learn Plan Profit group, and I pinned it on the actual live chat. So you guys can see I pinned a $100 off coupon. Again, you don't have to join, but if you've been waiting for a discount to join our trading team and to watch me trade live, it's an all-inclusive package. It's a one-time payment right now. Again, it's $100 off. And yes, it's lifetime access to all the updates as well. We're going to be updating the course in just 3 days. And it's going to talk about how to trade during a market recession, risk management during a market recession, and giving a couple more pointers and tips on what's going on with the Federal Reserve and how interest rates and inflation is used, based off of current market conditions. So again, everything is linked in the description of this video. I hope to stay connected, and I hope that you guys enjoy this live stream. I'm going to leave this up over here.
Past to data that we are receiving at an accelerated pace and with a scene that is changing geopolitically as well as economically.
Mr. Carstens, do you think...
But I don't want to sound too dark, because I think that there are also good things happening. You know, I was reflecting on your comments, Jay, and, you know, think back, December 20, when we thought that this pandemic was going to hit us for the next 2 years, at least, until such time when vaccination would come to market. And vaccination came about in a matter of, 9 months, as opposed to the 3 years that it normally takes. In the same way, everybody expected a couple of weeks ago that the Geneva Agreement of WTO would be a complete illusion, it would never happen. Well, certain things happen when there is goodwill, agility, creativity. So I have great faith in human inventivity and talent, particularly when it includes women.
A lot of these problems are happening because the recovery and the expansion have been so much stronger than and faster than expected. If you look in the U.S. labor market as an example now, it's a very good time to be in the labor market. You can, there are 2 job openings effectively for every unemployed person. So people are switching jobs, they're getting pay increases. It's a terrific labor market. The problem is that wages are moving up in some areas at levels that are not consistent over time with 2% inflation. So it's kind of overheated. Nonetheless, it's a byproduct of a very strong recovery.
Governor Bay, on pay increases, I mean, the UK is going through a bit of a bumpy ride with a lot of pay increases. How do you see that developing?
Well, of course, it's a reflection of the inflation world we're in at the moment. I mean, I'm on record as having said a few months ago that, and I'll be careful because I'll get it right and precise in terms of what I said, that I think very high pay increases, and particularly. And this applies to both pay increases and price setting by companies. If everybody tries to beat the inflation, and particularly the version we're having, which is this imported inflation shock, which we just we can't avoid, then it will set the second round effects off. And of course, yes, we are seeing some of that tension unfold. I would have to note that rather more people seem to be agreeing with me today than were doing several months ago. But that's not the point. I mean, the point is, yes, I think it was likely that we would see this, but I think I have to say the point about second round effects holds as much today as it did then. I mean, that's the risk, and that's why we will, set monetary policy, obviously, to offset those if they emerge to get back to target. We will have to do that, and that's I'm afraid, a thin code for saying the more they emerge, the higher rates will have to be.
But what sort of pay rises could be alarming for the Bank of England? Is anything above 2% inflationary? Well,
I don't think that's the right way to look at it, because obviously there's always a productivity angle to it in terms of how pay is set, and it's very important that, I made a general comment about second round effects, but of course pay is set in a market, and that's important, and it must continue to be set in a market. So it's wrong to say across the economy this is the right number, because it isn't. In different cases and different situations. But I would just emphasise this point about second round effects, which is the crucial point for monetary policy.
Mr. Carstens, has there been an over-reliance actually on monetary policy in the last 10 years?
Well, I mean, I think even going a little bit further away, 2007, 2008, monetary policy needed to respond, to put it in a different way, lack of resilience in growth. And yes, to some extent, policies that traditionally are meant to support some fluctuations in the business cycle have probably been used a little bit more with probably in a more lasting way. And my sense is the role of fiscal and monetary policy to stabilize the business cycle into the future are hitting limits. In fiscal policy is obvious because there are issues of debt sustainability, or can be issues of debt sustainability. And well, now if we had a long period where monetary policy could have an impact on growth, because as Christine said, as Jay Powell and Andrew have said, we faced a very, I would say, specific period of time of very low inflation, and where monetary policy could make, if you had the instrument, why not use it, no? But I think what we should learn, and this is not only, I mean, at the end of the day, the economies do not depend only on monetary policy. At the end of the day, they depend on fiscal, monetary, but also many other real policies that are out there. And what we have seen is in the last 10, 20 years, it's a very unreliable process of economic growth in the world. Some, of course, have been distorted by issues like wars or pandemics, but even before, I mean, we don't have the resiliency in growth that we would like to see. And that puts at different points in time a lot of stress on fiscal and monetary policy. And at some point that has some impact. So I think, yes, monetary policy will have to adjust, will have to evolve. We are learning lessons. But I think where we need to work more is to understand growth and how can we promote it in a more reliable fashion.
Who doesn't agree with that on the panel? Does everybody?
It depends what kind of growth. And I really think that the determination of the Europeans to focus and encourage investment in the green growth is critically important. If we want to develop the economic potential of any economy, you have to go in that direction.
That's the part of reliability.
Yeah. And resilience.
Yeah.
If you don't. Okay.
Governor Bailey and then Chair Powell.
Well, I was going to observe, I mean, a point I was going to comment on following what Jay and Christine were saying earlier about what we've learned from the last 10 years, and then make a point on growth. I mean, one of the things we learned over that period was that the underlying interest rate, the sort of structural R-star, seems to have gone down for a long period of time, actually, certainly in the UK when we look at it. The question is, what do we learn? You know, these structural issues that we're facing today, what do they imply for it? I'm probably not in the same place as Charles Goodall, because I think these trends are so long run, particularly on the sort of population side, on longevity side, that they have quite a long way to play out, even on the basis of what we know today. So I think the underlying story will obviously move, but there's a lot that's sort of built into it already. Just on the shorter run point on growth, I mean, I think one of the puzzles which we're certainly looking at on that, though, if you take that sort of underlying story of the last decade, certainly in the UK economy, is why hasn't investment been greater? Because there's a gap opened up between the sort of the risk-free rate and the return earned in the risk-taking environment, and yet investment has been very subdued. Now, I think the other question we have to ask there, but are we capturing investment there? I mean, it's something we're looking at certainly, which is there just more investment of a non-traditional sort, which probably not wholly, but in part helps to explain that. But I think, I see that as an important issue to understand in terms of what we want to know going forwards, because there's no question that investment is, that Christine was saying in terms of climate change, it is a big part of the picture going forward, and how we solve some of these issues that we've been living with in terms of low investment and low productivity in our case as well.
Chair Powell, do you think we've been over-reliant, actually, on monetary policy, especially as the Fed?
Yes, I do. I would just say, I think that in economic discussion generally, there's much too much focus on demand management and not enough on things that will make us grow at the maximum sustainable level, sustainable growth in the longer run. There's not enough focus on that. And that isn't the Fed's job. That's more the job of, again, elected governments. But I'd like to see more of that.
So how should governments be thinking about their economic policy going forward if monetary policy is not the only game in town?
You're asking me that?
Yeah.
So I'm kind of out of the business of giving advice to the fiscal authorities these days. So I would just say, I think when I get asked that by an elected representative, what I say is focus on investing in people and investing in things that will increase the productive capacity of the economy over time. That's what I say. And in terms of, I think what a central bank should do is stick to its knitting and do its job, and leave the major issues of the day to the elected representatives.
President Lagarde?
We have to stick to our knitting, that's for sure. But if we are asked for advice, we should give it. And I think that, to the extent that fiscal and monetaries have worked hand in hand during the pandemic and to good effect, I think we should also reflect on how fiscal can leverage what we do and how we can facilitate it. But we're not. This is no longer the same cooperation, hand in hand work that we used to do during the pandemic. And I would give the same advice: invest in people, invest in green, be targeted and focused, and in the medium term, the fiscal space has to be made sustainable for all countries, certainly in the euro area.
Yeah, Mr. Carstens, what's the correct way of fiscal policy to help monetary?
Well, I would definitely add my voice to invest in people, but I would say more in different aspects that enhance the human capabilities, very specific. Well, education is one. I think what we have learned with the pandemic is that health systems are extremely important, and I think to a large extent we have invested there. The other thing is that all digitation will imply in technological advance will really impose very, very dramatic pressures in many countries, and I think to how to adapt ourselves to that is very important. Climate change, as Christine said, is of the essence in many parts of the world. Incorporating ladies, females into the labor force is very important, and investing more in them, I think it's also of the essence. In many parts of the world, law and order is very important.
Yeah.
And so I mean, there is the good and bad things is that there is a lot to be done, but there is a wide variety of areas where we can act, and I think it can make a difference relatively soon.
Governor Bailey?
Well, I mean, Jay's right. Independence goes both ways in our world, and we must respect that, and we do. I think there's a common interest, going back to what I was saying a few minutes ago, in understanding why the trend rate of growth has fallen, because it has, in our case, it has fallen. Now, I don't then, for a central bank, I'm not going to start prescribing what should be done about it, because I think in most cases that will be outside our remit. But obviously, we have a strong interest in the trend rate of growth, so understanding the trend rate of growth is an important thing, and it's something where we can collaborate in that sense, I think, perfectly happily.
It's 3:27, so we only have 3 minutes. And I mean, I'd like to ask you just to close us off, Chair Powell, if you're speaking now to the American people to try and help them understand how long it will take for monetary policy to go back to something that resembles normalcy, what would you tell them?
I would say that we fully understand and appreciate how the pain people are going through dealing with higher inflation, that we have the tools to address that and the resolve to use them, and that we are committed to and will succeed in getting inflation down to 2%. The process is highly likely to involve some pain, but the worst pain would be from failing to address this high inflation and allowing it to become persistent.
President Lagarde?
Ditto.
Governor Bailey?
Oh, absolutely. I would just add one thing that is to Jay's point and Christine's point about understanding the pain. This form of inflation is even more painful for those on low incomes because it is concentrated in the essentials, in energy and food. And when you look at the consumption baskets of different groups of income groups in the population, sadly, it's those on the lowest income who are most concentrated in those things. And that is very difficult and something that obviously is very sad. But we have to do everything we can, because as Jay said, if we don't get it back to target, the consequences are worse.
Yeah. All right, it's 3:30 p.m. So thank you so much for joining us, and thank you so much for a great panel. I'm going to ask the gentleman to follow me, and Madame Agad, you stay on stage.
Thank you, Francine, for doing such an excellent job of moderating that session. And thanks to all of our panelists. We've seen a turning point, and now we've heard about how central bankers are grappling to avoid a tipping point where high inflation becomes entrenched.
Alrighty, so I hope that you guys enjoyed that live stream. Again, I would love to host more of these live streams. All I literally ask you guys to do is, if it's not too much to ask, is to drop a thumbs up and of course consider subscribing, as I upload new videos every single day about the market. If you guys have any specific questions that you guys would like to ask me, and or if you just want to stay connected, all the links are in the description of this video. You guys can feel free to send me a message via our little trading group chat. We have a little bit over 40,000 members. Yes, it is for free, and it's the first link in the description down below. I really do appreciate your guys' time. Thank you guys again for taking at least 30 minutes to an hour of your morning to join us and to see how the market reacted to that ECB conference. So I'll see you guys on the next one. Feel free to message me on Instagram, and feel free to message me via Discord. And again, all of that info is down below. The last thing that I do want to remind you is that there's only 2 more days for the Shop TechBuds iPad Air giveaway. So we're giving away an iPad Air. I know that this is not for everyone, but right now we're doing triple the entries. So for every $1 you spend on the site, you automatically get 15 entries. So if you've ever wanted any aluminum ore, if you've ever wanted a trading mouse pad, if you ever wanted anything, even a flag, right? Our last giveaway winner literally bought a mouse pad and won a brand new iPhone 13. So again, it ends in just 2 days. So this isn't a crazy giveaway that ends in about 1 month or 2 months. It literally ends in 2 days. A random person will be selected, and again, it only takes 1 lucky entry to be this month's giveaway winner, and for every $1 you spend, it equals 15 automatic entries. So this is at shoptechbuds.com, or you can click the 4th link in the description of this video. I appreciate you guys' time. Like always, let's make sure that we end the year on a green note. Take it easy, team.